From CBS 4, this is Haystack TV, powered by HaystackHelp.com. Finding reliable services can be like finding a needle in a haystack. With HaystackHelp.com, finding the needle just got a lot easier. Now here's the host of Haystack TV, Chris Kane.
Today we're introducing a local money management firm that helps pensions, endowments, and financial advisors build portfolios structurally, not dynamically. Dominick Paoloni is the Chief Investment Officer. Thanks for being here.
Thank you, Chris.
Now, what do you mean by structural portfolio management?
Well, if you think about traditional money management, sort of a block and tackle approach, stocks, bonds, sort of a 60-40, 50-50 mix, depending on your risk tolerance, is trying to control volatility and risk and give you a consistent glide path. With structural management, we're actually able to shape the distribution curve, eliminate market downside risk while still participating in upside market potential. And that's very, very exciting.
It is exciting and something I'm interested in because I'm tired of looking at my statement and lose money every single month. But let's put up on the screen actually one of your structural management solutions. Now this one shows a fully protected portfolio with 75% of the market participation on the S&P 500 performance over this time period. But can you explain the participation?
Yes, we custom build structures at our firm, as I said, for pensions, endowments, advisors, and select families. This particular note is a 75% participation with no market risk on the downside. So what that means is if you're up 20, if the market's up 20, you'd be up 15. If the market's up 10, you'd be up 7.5, but we're eliminating the market risk on the downside.
So there's no market risk?
No.
Okay, that's amazing to me. Where does the risk lie then? There's got to be risk, right?
Well, in all structures, where the risk lies is who backs that structure. If it's backed by a bank or an insurance company, if that bank should go out of business, then that structure will collapse. So that's where the risk lies.
And you teach this money management to students at the University of Denver.
Yes, it is.
The school I went to. Now, is this a new strategy?
You know, it's not real new, but it's not real old. The insurance companies have been using structures really since the late 90s. They actually package them within what they call an index annuity. The problem with index annuities and the problem with insurance companies is they're very long term. The value proposition on the upside is not very good. 3 to 5%, for example, might be a cap, and you're holding it for 10 or 15 years. And yeah, they say we don't have any downside. And again, it's only as good as backed by the full faith and obligation of that particular insurance company.
All right, well, let's take a look at another graphic here. Now this is another structured portfolio, and they come in all shapes and sizes, and they can be customized, of course, to client risk tolerance. But this one is your most popular.
Yes, it is. This is a proprietary product of our firm. And what it is I call it the iron butterfly, which it kind of looks like a butterfly.
Yeah.
But what we're doing is we're embracing volatility. We're not afraid of volatility. This actually makes money no matter which way the market goes. If the market goes down, the client's going to be positive. If the market goes up, the client's going to be positive. And with the volatility that we've seen in this market this year, this is just a really, really great alternative.
All right, and let's put up another one here and explain what we're seeing here now.
Well, this is, a lot of people say that, you know, they want to beat the market, but they want to take less risk than the market. Well, to do that, if you think about an advisor that has to get very aggressive, he'd have to be very heavy in equities, 75, 80, even exposed 100% to the market. Here is a structure where we're actually able to get 125% of the upside with buffered on the downside. What that means is the first 20% the client would experience, and then anything less than 20. If the market was down 25, the client would be down 5. But if the client was up 25, he'd be up 125 of 25, which is what, another about 32. So here's a way we can actually beat the market, but really protect on the downside.
Sure, and now who would benefit from one of these kind of portfolios?
Well, it's obvious. I mean, look what happened to endowments, pensions in 08. Some of the biggest endowments in Colorado lost high double digits. Endowments have an obligation to the constituents to be able to meet those returns, meet those liabilities. This is a great way to really deliver a very high value proposition at a high probable return rate by really shaping the distribution curve instead of trying to sort of block and tackle. So endowments, pensions, we work with advisors. And we also work in investment portfolio solutions with select families.
Okay, well, I hope I can be one of those families because this is very exciting. So Dominick, thank you so much for being here.